Hello and welcome back to another great session, loan closing and funding within mortgage production. So basically, this is the last leg of the mortgage production life cycle and consists of the following activities. Okay. So first one is loan closing, second one is loan funding, post-funding quality control. Okay, so as you look at the diagram here, so these are the main functions like the loan closing and funding, loan funding, and the post funding quality control. And this loan closing and funding as a process is basically like executing a necessary documents, obtaining all front end documents, and disbursement of the fund from lender to the seller of the property, and sending deed and mortgage to registrar office, which is the final step within a loan closing and funding process. Let's understand each one of them. What is loan closing, what is loan funding, what is post funding quality control, and what are the different activities performed in each of these pages. First one is loan closing. The closing agent will have received the instructions from the lender on how the loan has to be documented and the funds has to be disbursed, and will have collected all the necessary documents from the borrower and the seller and the lender. The closing agent will make sure that all the necessary papers are signed and recorded and that funds are properly disbursed and accounted for when the closing is completed. Okay, so usually the funds are transferred from the lender to the closing agent's account, who subsequently transfer the amount to the borrower's property seller's bank account. So the borrowers typically needs to come to the closing with a certified check for the closing cost, including the balance of the down payment. So the borrower can get the exact figure a day or two prior to the closing from the lender or the closing agent. Next one is the closing cost. One business day before the closing, the borrowers have the right to request a copy of the HUD-1 settlement statement. A document, what is a HUD-1 settlement statement? Which is a document that provides an itemized listing of the amounts that the buyer and the seller will pay at the closing, also known as the closing statement or the settlement sheet. The HUD-1 will, at this point, contain only the best information the lender has at the time, so its figures may change by the time you close. The following list reviews many of the costs that will be itemized on the HUD-1 settlement statement. Items payable in connection with the loan. So these generally include the points and other fees payable to your lender. The appraisal and the credit report fees are typically labeled as POC, which is also called a paid outside closing, because the borrowers typically pay these at the time of the application. There is a charge for the flood insurance, which provides protection for the lender if you are in a flood hazard area. Alternately, there can be a nominal fee to cover the cost of certifying that you are not in a flood zone. Items required by the lender to be paid in advance, commonly called as prepaids. These may include a mortgage insurance premium, homeowners insurance, and the mortgage interest from the date of closing to the beginning the period covered by the first monthly mortgage payment. Reserves deposited with the lender. These are the items such as the homeowners insurance, mortgage insurance, property taxes, and the annual assessments that will be held in an escrow account by the lender, payments as they come due. Okay, and what are the other things like the title charges? This category includes the cost of the lender's title insurance, which is regulated, varies from the state to state, again, because each state has a different title charges and is based on the value of your home. Again, it's based on your value of your home and the amount of your mortgage. So other charges such as the settlement fee, attorney and notary fees, and other title search fees may also be itemized here in this document. Government recording and the transfer charges. This category includes, if it is applicable, recording fees, city, county stamps, and state tax stamps payable for both deed and the mortgage and the transfer the taxes. Additional settlement charges. These may include the pest inspection, house location survey, and messenger fees for delivering the documents to be recorded in the land records at the courthouse. Property taxes are typically prorated between the buyer and the seller. For example, if the seller has paid the taxes for a period of time beyond the closing date, you would reimburse the seller. But if the seller has not yet paid the taxes for the current period, then the amount owed is deducted from your settlement payment. When it occurs, it's called as adjustment. All right, next thing is the closing documents. Among all the documents you'll be required to sign at the closing, which are critical from both borrower and lender perspective. First one is mortgage note or a promissory note. So in this note, basically, it's basically terms of your agreement with the lender, the borrower's agreement with the lender, and the terms for the repayment, and including a late charge if you do not pay in a timely fashion. Next one is the deed of trust, a document in which a borrower pledges his or her property to the lenders as a security or collateral for the repayment of the amount borrowed to purchase the home. Next one is the deed. The document by which the title to, meaning or ownership of the property, real property is transferred or conveyed from one party to other, such as from a home seller to the home buyer. In case of a newly constructed property, borrower will also need a land survey, all the receipts for the tax payments during the construction, a certificate of occupancy required by building code in many areas, and certificates from the local health department for plumbing and sewer installations required in most areas. If anyone agrees that the paper are in order, borrower and the seller will each submit a certified check or a cashier check to cover the closing cost and the balance of the funds due. The check from the lender covering the mortgage amount will then be submitted to the closing agent. Okay, so if the lender will be paying your property taxes in the homeowner's insurance for the borrower, a new escrow account will be established at this point of time. Then the borrower will receive the keys to their new home. Next one is loan funding, or which is also called as warehouse funding. So post-closing, the loans are said to be warehouse till they are pooled, sold, and delivered to an investor. Pooling requires the production of a certain mutually agreed, mutually agreed documents. So pooling requires the production of a certain number of loans. Also, there must be a buyer of the loan which needs to be fetched. The investors, who are basically the buyers, would also take time to verify that the pool conforms to their requirement and meets their standards, the pool size, pool size, mean interest rate, borrower credit score ranges, etc. In the meantime, the lender's money is blocked in the loans in the warehouse till they are successfully shipped, and investor credit them back with the sale proceedings. Lenders need the funds to continuously originate the loans. Warehouse lending is an interim financing agreements for the lenders to finance new origination while the old loans are in the process of getting sold. Warehouse lenders are lenders to the lenders. The primary lenders have a line of credit approved for them from the warehouse lenders, within which they can raise the funds. The following is the detailed process. First one is approved customers submit a free funding package. Okay, so completed the loan application, which is called as Form 1003, appraisal, first two pages of the appraisal. And next one is firm committed by the DE underwriter, which is from the FHA, Federal Housing Administration or Authority. VA loan analysis by the VA automatic underwriter. If it is a VA loan, then VA automatic underwriter would perform the loan analysis. Investor underwriter, loan prospector, and the desktop underwriter, which are from the Fannie Mae and Freddie Mac. So these are the automatic systems which are used for underwriting the pool of loans. Copy of borrower's credit report, insured closing letter in the name of the originator from the little company, title company, the writing constructions or wiring instructions, copy of the hazard insurance policy or the binder of back coverage, flood certification, mortgage insurance or guarantee certificate of eligibility if it is applicable, purchase commitment from the investor, which is called as investor lock. On approval of the package received, the funds are sent directly to the settlement or the closing agent, settlement agent, who is also called as closing agent, in escrow for closing. On closure of the mortgage loan, the settlement agent sends the original mortgage note to the warehouse lender, endorsed in the blank, and copy of the HUD-1 settlement document, following is a more exhaustive list, like original signed mortgage note, certified copy of deed of trust, copy of title commitment, copy of HUD1, copy of truth in lending. So these are the documents which need to be processed at the closing of the warehouse lending. So the balance of the package remains with the customer in most of the cases. The customer first closes the mortgage loan and prepares it for delivery to the investor. The customer ships the credit package to its investors. Okay, so on receipt of its delivery instructions, the warehouse lender ships the note. The warehouse lender completes the endorsement and ships the note in accordance with the customer instructions, accompanied by the warehouse lender's Bailey letter to the investor. The investor transfers the purchase proceeds to the warehouse lender's collection account. The warehouse lender subtract the following: warehouse facility principal, okay, interest payable to the warehouse lender, loan transactions fee due. The balance, which is customer's profit, is transferred to the customer's bank account. Treasury and finance applications is the enterprise usually provide the customers with the details of all the receipts, deductions, and transfers on a loan by loan basis. All right, so let's learn about forced funding. What is forced funding quality control? HUD, Freddie Mac, Fannie Mae, and most private investors require the lender to have a quality control unit that independently assesses the quality of the loan originated or purchased. The quality control function tests a sample of closed loans to verify that underwriting and the closing procedures comply with laid down policies or practices, government regulations, and the requirements of the investors and private mortgage insurers. The unit confirms property appraisal data and the borrower employment and income information. It also confirms the fraud prevention, detection and investigation functions. It also checks for the compliance with the various regulations. This is all about loan closing and funding. I hope you enjoyed this session, and I will see you in the next lecture. Thank you.